Did you watch Jim Cramer yesterday? We're going to talk about that briefly. In addition to that, again, as always, we'll go through our morning checklist and everything that comes with it. Why are you joining us? Well, once again, if you do not join us at 8:45 and you're not here with us for the first 45 minutes before markets, you are someone else's lunch money. The reality is that the 9:30 opening bell is when exit liquidity kicks in. So it's very important that you get in here with us, talk about the safety and security of the markets, understand if this is a trap day or not, get our breakout picks, and understand exactly where the smart money is positioning. And today, very important little bit of a breakdown, an extension of what we did in our member room yesterday, talking you through how to build a watch list of your own to identify breakout stocks and breakdown stocks. I had the slides done. I might as well share it with you this morning. Real quick, on the bigger stories, kind of like what everybody's chatting about this morning, U.S. and China, ongoing negotiations in Stockholm between U.S. and Chinese officials aim to extend the current trade truce ahead of that August 12th deadline, supporting global risk sentiment. That's very important to the energy sector, which we've been digging into in recent days. We noted that oil prices had been ticking higher. Crude now up another 0.5% on the Brent side, WTI up 0.6. We were trading SLB in our Tesla room. Strong little breakout move on that stock. We took some gains yesterday. I know Eric in Northport was excited about that. In addition to that, the Fed's meeting today. The Fed? Who are they? What do they do? Oh, yeah, that's right. Nothing. The Federal Reserve will begin its two-day policy meeting today, and the only thing that anybody seems to care about tomorrow at 2:35 is the question that is going to be asked by some journalist who is never going to be allowed back in the room ever again. Are you staying or are you going? That's really going to be the noise. That's going to be the news. That's all anybody's going to want to ask about. And I do want to remind you that when it comes to the journalism pool surrounding the Federal Reserve, the reality is that they contain what questions are asked. So expect that question, but expect it to be very well worded and run through a political relations committee ahead of time. In addition, earnings, 80% of S&P 500 companies have topped Q2 estimates, and the S&P 500 and NASDAQ are at fresh record highs heading into the earnings that we will have this week, built around Amazon and Apple and Meta and Microsoft. Very, very busy. Hey, before we do anything, I know that Don was excited about baseball cards, so I'm going to celebrate this morning. We're going to do a new feature here. We're going to do this every Tuesday, where I'm going to celebrate a baseball player, and we're going to celebrate Paul Skeens, who is now in Walter Johnson level records, 220, 212 on the ERA, and bang, there it is. There's the patch card, auto of 25. This is very exciting. I'm very happy, and it's going to go right back here with our Wall of Fame cards that include the Juan Soto rookie and the Jackie Robinson card. Celebrate Paul Skeens every day, any day. Yes, very sorry to hear about Mr. Sandberg as a Cubs fan. All right. Hey, Skeens would strike out everybody. Hey, speaking of bad things. Well, if you missed it, Mr. Cramer had a moment yesterday, and I always pay attention to what Cramer's saying, because usually, again, we make fun of the fact that there is this inverse Cramer ETF. He is a good measurement of sentiment, right? So the last time that I talk about what Cramer did, I go back to this period here. This is a very transformative moment for me as a trader and as an economist. It happens back here in October and November of 2022. Cramer had been very, very bullish on Meta, the social media company, and this company was spending, or was planning to spend, as much money as the United States government did on the Apollo missions to try to create a virtual reality space where a bunch of people could just wear helmets and interact with one another rather than just being human beings and having conversations with one another. That said, he went on air right around this time and he said, look, I got this wrong. I was wrong. And then I think he cried. The problem is that he did not seem to understand that there was a broader macroeconomic event transpiring that had nothing to do with Meta. It had everything to do with the guilt crisis that was transpiring in Europe. Now, for those who don't recall, every single major financial crisis that we have had in the 21st century has largely centered around safe assets. And what do I mean by safe assets? Well, bonds, mortgages, things that historically people have said, yeah, who shorts housing? Yeah, why would you short government bonds? Those, that's the risk-free asset. The reality is these risk-free assets, when interest rates change dramatically and rise, have impacted the liquidity of major financial institutions. And in the case of England, they had a pension crisis because the gilt were their government bonds. Their yields accelerated. When the yield of a bond goes up, the price of that bond goes down. The problem is if you need to sell a lot of these bonds in order to raise cash and meet your pension obligations, then you create a liquidity shortfall. And what happened was this led to an event in October and November of 2022. It cost Liz Truss, the prime minister, her job, and the government effectively nearly imploded. The Bank of England needed to step back in. The United States Federal Reserve helped provide some support. We started to sell a lot more short duration T-bills to help increase credit and leverage in the system. And the market took off from there, including Meta, which went from $80 all the way up to $700. Mr. Cramer didn't do anything wrong, except, tell everybody to buy Meta when it was at 300. The thing about this, when he cursed on air yesterday and he said, what is the Federal Reserve doing? It feeds back into the mechanism that we are going to spend an immense amount of time in the next 24 hours thinking about what the Federal Reserve is doing. And the reality is, for the most part, the policies are all over the place. And it just is a reminder that we are putting way too much faith in centralized planning, because that's all the Fed is. The Fed decides what the interest rates are. That is not the cost of money. I want to point that out. Interest rates are not the cost of money. The real true cost of money is the Forex rate. And now, as I point this out, why the Fed's fight is largely noise. We have had massive fiscal and liquidity measures that have transpired in the last few years. We injected 30% of every dollar that has ever been made. Now, Janet Yellen will tell you that that is not what caused inflation. But the reality is that inflation is always a monetary phenomenon, as we know. There has been persistent excess liquidity and consumer reliance, despite the fact, right, we're seeing a spike in auto defaults. But for the most part, the American consumer has actually shockingly remained resilient. We haven't had massive levels of default. We haven't seen people defaulting on their mortgages at levels that we saw back in 2008. We've had warnings about this, but it has not been that persistent. In addition, the Federal Reserve's policy is not necessarily what is creating all of this capital that is flowing into the financial system. Why is the market moving higher? Well, again, the M2 is at an all-time high globally, but the bulk of the new credit is coming through the shadow banking system. It's coming from hedge funds and private equity and private credit, and it's coming from the Treasury Department issuing short-term T-bills. Now, according to a statement that was made by some people this week, Trump was actually exploring the idea of actually just only issuing T-bills for the U.S. debt until interest rates came down, and then they were able to refinance. If that were to happen, I don't know what would happen to the financial system. I have an expectation that it would create massive levels of leverage and liquidity in the system, which would drive stocks to an all-time high. I would not even know where to even begin to unwind that level of positioning to try to get people out of short duration T-bills and into longer term debt. That's one of the big challenges that we have ahead. Debasement is not hidden in the CPI. It's hidden in the markets. And one of the things that I think Mr. Cramer misses, and I think a lot of other people miss, is the fact that high all-time levels in the stock market are a form of inflation. The reality is that when retirees look at their 401ks and they say, wow, like I've got a lot more money, they are going to be willing to spend more. So the Fed is in a difficult position because it can't force the market to go lower because it creates leverage issues, particularly in the FANG stocks, and issues involving all of the Treasury bonds that are being levered up. But at the same time, High stock prices are a form of inflation as well that impacts the spending patterns of Americans. And the last thing that the Fed is dealing with is the fact that most of our recoveries, particularly since 2008, have been K-shaped, meaning that the top percentiles of Americans in wealth have done very, very well when policy bailouts come, and the average American is still treading water, trying to make up from the COVID crash. So this is a very difficult situation. I don't think that people really truly understand what's going on. And I'd say that I understand about 95% of it, but it's the last 5% that is always very, very difficult to wrap your head around. So in this event, again, next 24 hours, too much emphasis on what the Fed is doing. And instead, what you need to do as a trader and as an investor is think about what you can control, right? Continue to focus on the things that are going to be maintaining the ongoing trend for the foreseeable future. And that is more money printing, more monetary inflation. And what your goal is to keep your head above water and do your best to try to ensure that you are staying ahead of the continued debasement as it goes. And I'm talking, you're going to need to make about 10% a year. You're going to need to figure that out. Now, fortunately, today at 2 o'clock, I'm going to be, or 1 o'clock, forgive me. I'm going to be joined by Blake. We're going to be talking about the 10% per month club. So join us then. Click the link, get a front row seat, because this is one of the most important periods of the year right now for traders and for investors. And you really need to be focused on how are you going to ensure that you are protecting yourself and insulating yourself from ongoing challenges and mistakes at the Federal Reserve. All right. Every day, we give you a number, and that number is the number of stocks that are breaking out versus the number of stocks that are breaking down. Very simple mathematics that we have utilized for the purposes of avoiding financial crisis. And there is no shortage right now of people out there right now saying, hey, there's going to be a correction. Hey, we know there's going to be a correction. We know that the market is going to go down at some point. But once again, the market can remain irrational longer than you can remain solvent. And I know that Don wants to go right through the wall, but the reality is that I am a very patient person who waits for specific moves on technicals to ensure that I am not betting against an increasingly insane market. I have met people who have lost almost everything trying to short Tesla because Tesla stock continued to burn higher in 2017 and 2018, and not understanding the broader impact of liquidity in the system and how it costs them nearly everything. Right now, the S&P 500 remains well above the support level of the 20-day moving average, which is very important. We are specifically looking at the number of stocks that are in breakout mode versus breakdown mode. And if that number goes negative, then we turn over and look at what is called the FNGD, the Microsectors FANG Index Inverse ETN. You don't need to know what it is. All you need to know is whether or not it is above or below its 20 and its 50-day moving average, because any time that it is above its 50 and 20-day moving average, we have had something pretty gnarly happen in the financial markets. And as I have noted, this is a sign of leverage leaving the system, which impacts those top stocks in the S&P 500. So for right now, we're all clear. But things can change in 24 hours very quickly, particularly built around the Federal Reserve and, of course, earnings reports from some of the top names in the market. Stocks that we're looking at this morning that are in breakout territory that continue to be strong are AMR, NRP, PSTG, and EWY. And I'm going to tell you very simply, I've never heard of any of these names, right? Except for the EOY, which is the strength in the South Korea ETF. But NRP, you got me. I couldn't pick that one out of a lineup if you tried. Natural Resource Partners, LP, that's a coal company. Wow. Weakness, CART, that's Instacart, obviously, or whatever we call it now. What is it, MetaBear or Maple Bear? Oh, little guy breaking under that 20-day moving average, a little bit of weakness. And as I'm going to walk you through in a little bit, we're paying very close attention to the RSI, MFI, and MACD. all of these things flipping over. That drop under that 20-day moving average is very important. As I've noted, I prefer to wait until we have a broader negative momentum event to try to short stocks. But as we see, we are under these key levels. Wing is in play right now. That is Wing Stop. Don't know why they're a public company, but they are. And continued weakness that has transpired since dropping under that 20-day moving average. As I've said, when I look at stocks that are heavily overvalued, particularly a high P ratio and high EV to EBIT, when we break under the 20, one of the first trades that I like to make is trying to run this stock down to its 50-day moving average, which means I buy an in-the-money call or at the money call right at the 20-day, and I sell the 50-day moving average put. And the reason that I do that is in the event that the stock does turn back around and move higher, selling that put down here gives me a little bit of a cushion to help offset any potential weakness that I have in that position. It's just a very short-term trade, but it is the difference that allows me to avoid, say, a 20% loss and instead likely incur somewhere between a 5 and 10% loss if I structure that trade properly. We'll be digging into that more today at 12:30. In addition, same stocks, a lot of these names that I talked about recently, RNGR, Ranger. And this is a energy play on the backside of our good old friend Momentum. Pulled this name out of the hat yesterday. Nice big move above that 20-day moving or 200-day moving average as well. Stock has now moved from about 12 bucks to 14.07 since hitting our watch list. AA is on the board as well. Interesting to see Alcoa back on, but resources remain strong at this moment. It is holding above that moving average, and we're trying to get back above the 200. There is a lot of upside in materials if we can get there. And once again, the backdrop of trade deals between the United States and the EU, and of course, what is happening between the United States and China would be very bullish for aluminum. WB, man, this stock is just the one that keeps giving. Great momentum stock, and definitely a stock that if it is touching its 20-day moving average, you want to start looking for another move to the upside, staying in the money at this moment. The last time that I've recommended this stock, it had just crossed its 20-day moving average in May. We had a nice little run to about 950 in this event. As you start to see stocks like this continuing their strong, smooth momentum, the reality is you're looking for higher lows and higher highs. So right now that 20-day moving average sets up for a potential move back up, and you could see in the channel looking relatively strong as it holds. If it rolls back under its 50-day or 20-day, you let it go. But for right now, I like the idea of just simply trading something that is probably a 70 or 80 delta call option on Weibo, one of my favorite momentum stocks. And MSCI back in play. This is a lot of insider focus. Once again, if we can get back above the 50, the 20, and the 200-day moving average, I would like to see this potential upside back up in that 600 level. MSCI basically is the financial markets, so it's very important to just remember that you want to always try to step in on this stock on weakness. Insiders tend to buy a lot of this stock when it is structuring and when it has a major sell-off, as we just saw. Coming from about 58, 580 down to 525. Executives have been buying the stock since. All right. What about lithium? Not even focused on it today, but we'll dig into it in a moment. All right. So I want to just point this out. I want to keep this. When did it change its name to Maple Bear? I think it was it a SPAC? It was one of those just like random things. It was like, that has nothing to do with anything. All right. So Redux for everybody. Once again, pick a stock, any stock will do. Let's go with Exxon, which will be reporting earnings on Friday. What we're looking at with Exxon, once again, Exxon has a very strong correlation to the OIOU, by the way, as we've always discussed. We're always looking for strength on energy on the upside. We break that 20 and the 50. We go long, high beta stocks in the energy space. We fall under that 50 and that 20. We go short, high beta stocks in the energy space as well. But if we just look at Exxon, just to bring you through the 4 different indicators that we're paying attention to, all of them are momentum indicators, right? They're all working together. Now, I know a lot of you likely know the relative strength index. And in fact, somebody sent me an email today saying, hey, what you're talking about is actually pretty basic. The relative strength index, I know what that is. Yes, a lot of people know what the relative strength index is. And the reality is that some people use the RSI exclusively. And I'm here to tell you that that is a mistake. You want to utilize multiple momentum indicators for the purposes of building conviction and also to identify the fact that there are more than one type of momentum in the broader market, which gives us the RSI. So the RSI, just to start it off, it is a scale of 0 to 100. When it is over 50, it is implying bullish momentum on our daily chart. Very important. I am not focusing on intraday. I'm not focusing on the 3-minute. All of that matters. All of them work in tandem, but I am focusing on the daily to build conviction and to follow the trend. The RSI under 50 implies bearish momentum. So oversold on the RSI is typically about 30, and overbought is at 70. But in high beta stocks, companies like Tesla, for example, 80 is considered overbought on RSI, 20 oversold. Now, what you're going to see is this second one, and that is the money flow index. The money flow index uses price and volume to measure buying and selling pressure. An MFI over 50 confirms buyers are dominating with volume support, and it is often considered a volume-weighted variant of the relative strength index. This matters because in the event that the MFI is actually dropping and the stock is moving higher, that actually should be a red flag because a low volume uptick in a stock could signal, well, effectively, if we look at the S&P 500, we could signal that wall of worry that we talk about with the Magnificent Seven and those other big names. I highly encourage you to always pay attention to the RSI and the MFI, especially with the OILU. When the OILU in the energy sector is oversold on both the RSI and the MFI, this signals to me that we are in an environment where energy prices, oil prices have moved into oversold levels. And resultantly, what I'm looking to do is now look for a recovery trade relatively quickly. You can see right here that the OILU pushed into oversold territory in December. If we turn around and we look at a company like Apache, which is a higher beta variant of the upstream oil and gas space, you could see that right when the OILU hit oversold on RSI and MFI, Apache rebounded. And not just rebounded, moved from 20 up to 25 in about 2.5 weeks. With a very cheap option, that is a very strong slingshot style reversion trade that we're constantly looking to take advantage of. On top of that, you have other indicators like the ADX. The ADX measures trend strength, right? So the positive DI, right, the divergence level here, that is your green right here, and you have your red, that's your negative DI. When your ADX is above 20, that is a bullish trend. And again, it can also be bearish, but again, it just signals that there is a strong trend in movement. So you want to see strength in RSI, strength in MFI, and that ADX start to improve. And resultantly, what you will see when you see that crossover, pay very close attention to this chart on Apache, where we crossed over 50, and the ADX turned positive. Strong trend. ADX, Apache goes from 17 to 21 in about 2 weeks. The final one that you want to be focusing on, remember, you're focusing on a bullish trend, you're focusing on a bearish trend. This is for confirming if a breakout is sustainable. The final thing is the MACD. And the MACD is the moving average convergence divergence. Don't say it too many times or your nose will bleed. MACD identifies changes in momentum and trend direction. So the MACD line crossing above the signal, as you can see marked by the black over the red, that is bullish. If it drops under, that is bearish. Now, what you're looking for is on a daily chart for all of these things to align at once. That can give you strength and conviction in finding a trade. So again, if you look at this situation here, this is back in December again. Positive swing on the MFI, positive swing on the RSI, crossover positive on the MACD, crossover positive on the ADX, plus a break above the 20-day moving average. Even if you were late to the reversion, you had a stock go from 22 to 25 in about 2 weeks. That's a 10% move on the stock. That's an opportunity to make money. So follow these indicators. There are plenty of books out there. You have AI at your disposal. You have all of these tools to help educate you. And I obviously talk about this stuff every single day. At the end of the day, you're looking for RSI over 50, MFI over 50, ADX over 20, and a positive MACD. This setup confirms trend strength, momentum, and volume support. And as I have noted time and time again, we screen this pretty simply over at TradingView using this breakout screener that we use each day. And the stocks that are moving higher right now, MasterCard is moving higher ahead, I believe, of its earnings. EIX, which we talked about yesterday, the stock had a little bit of weakness, but it still remains above those key lines. We're always looking for names that are above 48 on the MFI and the RSI, because we're trying to find names that are about to meet these thresholds. So as you could see, CRGY was on our list yesterday. CRGY had a nice little move to start the day. CRGY, which is a private a company that was built off a spinoff for upstream oil and gas M&A. Nice move from around $9 up to $9.59. Some of these other names are the same from yesterday. PD is back in there. I keep thinking Diddy. I don't know why, but PD. One of the things about a move like this, though, is that this allows us to qualify. So with AI at our disposal, how do we use it? Ask if it's bullish on API and why. No, what I'm suggesting here is just so that you can learn how all of these different indicators align together. I'm not even focused on what Apache's doing operationally. I'm simply trading the price. I'm simply trading the trend. I'm not even focused on how they're doing operationally. Instead, what my focus here is the momentum, the volume, and the beta. It's a 1.25 beta stock, and it's one of those names that when you are presented the opportunities based on the OILU, that you can follow this trend higher, and you can look to try to take advantage of strength in Apache as it moves above its 20 and its 50-day moving average. What would the query be? I mean, just simply state, I want to understand how RSI, MFI, MACD, and ADX all align to help me identify better momentum trades. And it will kick off a pretty lengthy screed on it. You can also ask it for academic support. There's not a ton of academic support out there. There's only a handful of reports that have been written on this. I know that JD Henning has written about this. I know that we've seen some more technical reports that have been written, not by financial professors, but actually through like behavioral psychology professors who are constantly studying financial markets to understand herd mentality. But play around with AI, ask questions, have a conversation. Tell it, hey, you know what? You're Stanley Druckenmiller. Tell me about reversion trades. Ask questions. There's no stupid question. It's smarter than me. WTI and offshore. Ooh. Again, these little tiny names that pop up. $1 stock, looking for momentum to continue. Kind of like that. Very cheap stock. And look at that most recent move. So 183 WTI at the top of the list. Now, the same goes for the other direction. Very important, right? When stocks start breaking down, you're looking at names that have weakening momentum, right? Keurig Dr. Pepper is effectively in this little arena right now. The stock's been consolidating and chopping for the better part of a month and a half. But as you can see, all of the indicators are negative for Keurig Dr. Pepper, and it is under its 20-day moving average. Very good. KDP is on that list. SFM, wow. That's a shame. Sprouts Farmers Market. Oh, well. And once again, if you are shorting some of these names or you are long some of these names, make sure that you're paying attention to RSI and MFI to determine whether or not momentum is strong. And effectively, this could be a period where ultimately you start to see profit taking off of these names. Do not ever be afraid to sell. Don't get overly greedy. It's important to be a little bit greedy, but recognize that the purpose of the market is to sell. So it's very important that you take gains when you have them, learn how to position, not just position size, but also as you start to trade, recognize that there are levels that you want to exit from a target perspective. And remember, some of your targets will remain stops. So a good example of this, I'm going to walk you through a reversion that happened yesterday that, unfortunately, I know some people who were in the Tesla room caught this, but one of the things we're always looking for are these types of moves where the S&P 500 falls off its third standard deviation path. This is volume weighted average price. I've talked about this extensively. It's very important that everybody learn it. It's very important that you learn it from an options perspective to know where you are. If you're ever shorting a market, the last thing you want to do, or shorting a stock, the last thing you want to do is buy puts when we're down here, right? Because this is the standard deviation from the 1 minute volume weighted average price, which is more or less a magnet for institutional traders. When we see these types of sell-offs that push into the fourth deviation line and also push beyond the Bollinger Bands, that is a time that we start to seek reversions. And what we do when buying calls, 0-day calls, or trading accordingly, every single deviation back to volume weighted average price becomes an exit. So I typically buy in threes. And the reason that I'm doing that is that I can sell here, I can sell here, and then if we break VWAP and continue to move higher, this will become my stop for the day, the volume weighted average price. But if we get up here and then break down, I'm going to sell here. But let's say that we actually do move higher. So you sell here and you push here, and then we roll over. Well, this becomes my stop once again. So what I'm saying in this regard is that if you're owning a stock like Apache and you own a call on a stock and you have three positions, what I have done historically, and a good example of a trade that I did recently with Apache, it was with Tesla. I had a 75% gain on the Tesla underlying call, and then it started to roll over. Well, my second position, I stopped out at 50%, and my third position, I stopped out at 25%. Now, ultimately, that last 25% ended up rocketing back to 75. But the way that I structured the exit of that trade, it ensured that all three of my positions on a weighted percentage ensured that I made 50%. So before you make the trade, know what your exits are and recognize that you're trying to generate a good, nice round number, but you're utilizing stops and protecting your gains. Very, very simple way of looking at the markets, and very, very simple way of recognizing that now that I'm in the position, right, I am optimizing in order to exit. I'm not hoping, I'm not wishing, I am being disciplined, and I am focusing on key levels that would allow me to exit that position. Now, as I've noted, if you are interested in learning about these reversions, we still have availability on our mastermind. I have just spent a good 2.5 hours last Thursday adding in the Bollinger Band capacity with the volume weighted average price, which makes this a very unique setup for the coming weeks, particularly with so many earnings. And we're always looking for these overreactions each day because they set us up for high probability trades. All right. The purpose of the market is to sell, Crazy Fox. A couple last things just to pay very close attention to, just noting that the futures palladium continues to be a very good trade. Yes, 112 right now, a little bit of a sell-off after we pushed up to that 120 level, but as I've noted, that was kind of expected in line. We were trying to get back to that long-term adjusted 50-day EMA. I remain bullish on palladium. I was in at 99, pretty sizable position on this. I still foresee a relatively strong rebound on this. If you're looking to get in on palladium, I would focus your attention around key moving averages. We're trying to get above that 120 level on the weekly chart. On the daily chart, we continue to find support back at that 20-day EMA. So if you haven't entered into a palladium trade, you might want to wait for a move above that 120 level or a pullback to 109. Either will do. And Secret Agent Charlie saying that he is Team Pal. That's exactly what I'm talking about. In addition to this, just pay very close attention to the oil markets. If we move into next week, this is just one of those events right now where we currently foresee exactly what the markets do. You know, when we get these positions that lead up to significant pops in oil, and then all of a sudden there is an announcement, well, the purpose of the market is to sell. If we go back into June or we go back into May and we recall what transpired with Iran and Israel, we had these big moves up. And then the very second that it just dissipated, it just blew up. And all of these CTAs have to get out of these positions. So don't be shocked if we get a trade deal. Don't be shocked if we, see cooperation. And then all of a sudden there's weakness in oil. And you're going to come back and you're say, but Garrett, why would it sell off the way it did? I thought that this was all bullish for global macroeconomics. It is bullish for global macroeconomics, but the reality is it's about the positioning of the CTAs and all of the people who are speculating on oil and not necessarily the actual news. If the purpose of the market is to sell, the purpose of the market is to take gains, and first mover advantage will be given to the people who entered these positions back around $60 per barrel and are now taking 10 to 15% profits while everybody else is panicking. All right, it is 9:21. That means Don's going to start playing music in a couple of seconds. I will be back at 12:30 in our paid room, in our membership room. But at 1 o'clock, I'm going to be live here today with Blake. We're going to be digging into the 10% month market. I really am looking forward to this presentation because, as I said, in a world that is dominated by the Federal Reserve and a lot of concerns about the broader market, it's about having a structure and a strategy that will allow you to stay ahead of the curve moving forward. So join me again today at 1 o'clock. Click the link, get this on your calendar, and I will see you then. Have a great trading day. I will talk to you tomorrow, 8:45. Market Masters. Take care. Take care.